Well, Rajeev Thakkar joins us now. Let's connect with him to talk markets, Berkshire Hathaway AGM, what his view on some of his contra bets is, and at this kind of an environment, how is the risk reward ratio stacked up? So, Rajeev, good morning. Thank you for joining us. What shall we start with? Berkshire Hathaway AGM, your holdings,
Up to
or
you.
what is keeping you busy?
Whatever excites you. I'm fine.
Let's start with Berkshire Hathaway. And Berkshire Hathaway this time was minus Charlie Munger. For those who followed Charlie, they would say, we miss you, sir. But what is important here is that the zeal, the energy, and the profoundness with Buffett also really chaired the AGM, quite extraordinary. That people would say that he's 91 years old, but I would say that he's 91 years old young.
Yeah. Yeah. We all of us missed Charlie Munger, and Buffett, of course, carried on the marathon session early morning till evening. The interesting part was that at the end of it, he closed on a bit of a pessimistic note. He said, I hope all of you come back next year. And he also said, I hope I come back next year. And really, the meeting is dependent on him. And we saw Mr. Greg Abel talk about the operating businesses and things like that. And of course, he's a very competent manager. But I don't think 40,000 people will turn up in Omaha if Mr. Greg Abel and Mr. Ajit Jain were to run the meeting. So I think we are in the last leg of the Berkshire meeting. So that is somewhat disappointing.
Well, long live Warren Buffett, that's what I can say. Rajiv, let's talk markets. And in this kind of a market, some would say that you are running out of options. For a classic value picker like yours, who likes to buy cheap, who likes to buy good businesses when there is fire sale in the market, there's no fire sale and there's nothing cheap. So how are you investing?
Little bit of cash. So the interesting part about cash is it will give you 7% at the end of the year without taking significant amount of risk. So yeah, again, tying into the Berkshire meeting which happened this weekend, he already had so much of cash. And the very interesting thing that happened, I would say the key takeaway was that he went out and sold Apple shares. Uh, he's definitely a long-term buy and hold kind of person. He's been an advocate of not paying unnecessary taxes where uh, he would end up paying capital gains on his tax on his Apple sale. But still, he went out and increased the cash holding rather than deploy some money. You are right. Whether it be US, whether it be India, most things are not attractive. Most things are expensive, but at the same time, there are pockets of value. So just before I came on, I was listening to your take on Kotak Bank, for example, or the banking sector in general. So private sector banks have not done much in the last 3-4 years. So a lot of them are available just slightly above the pre-COVID levels. So almost a 4-year kind of flattish kind of performance when earnings have grown, when asset quality is stable or has improved, and so on and so forth. So in each bull market, there'll be pockets of exuberance, but there will be some other pockets which will be out of favor, and that's where we tend to look for opportunities.
I think
Which
private
come.
banks are underperforming. I mean, there's nothing wrong with the franchise value. Growth keeps on growth is evident. We can argue about whether it is 15 or 18, but growth is there. NPAs are not there. Retail books are strong. So when everybody is so bullish on India, and when the growth in the near term for next 2 or 3 years is looking so strong, private banks are supposed to be the best proxy, but they are getting a stepmotherly treatment. Why is that?
So for it baffles me, Nikunj, and my guess is I don't have a data point to back this up, but my guess is people have unnecessarily got excited by this whole NBFC rush or the alternative lenders. So people, so you've been there long enough. So in mid 90s, there was this thing of every corporate house wanting to set up their own NBFC, and a lot of them set up and had a bad experience at the end of it. I'm seeing echoes of that this time around as well. So many NBFCs are being set up, both traditional NBFCs as well as fintechs, to do all sorts of things. And banks with a lot of franchise value, as you put it, those are being ignored, and people are rushing in for the newer businesses that are there. That's my reading of this.
You've been very contrarian. For example, when you bought, let's say, Hero Motocorp, or when you bought into ITC. These are two distinct names. I think Persistent, you were contrarian, and as investors, we asked you at AGM, bhai kya kar rahe ho? You said, look, I like the company. You kept your patience, and then it turned out to be like one of the best investments for your unit holders. Where else are you finding this kind of an contra opportunity apart from private banks? We've discussed private banks. Apart from private banks, where you think that the intrinsic value of the business or the franchise value is significantly higher than what markets currently are betting on?
So the infographic was there on the screen. So our for good or bad, our portfolio is public information, and every month we put it out. And for the month of April, things will be out shortly, but it will be more or less the same names. You won't see too much of a drastic change. So IT services, again, growth is not there right now. Numbers are very, very flattish, and it goes through its cycles. Right now, people are worried about what will be the impact of the generative AI on IT services, and whether fewer people will be required and pricing will come down. I think it's going through a cycle. Valuations are reasonable over there. That could be one space. The other space, as you can see, we are invested in some energy-related utilities or energy-related mining companies and things like that. So again, to tie in maybe some of the comments at Berkshire Hathaway meeting, Mr. Greg Gable mentioned about the incredible electricity demand that he's seeing, and how much of capital expenditure they will need to do in that space. He spoke about doubling of energy requirement and tripling of energy requirement in some areas in the next 5-6 years. So that is the extent of energy demand that is coming up, and it is coming from two sources. One is the data centers and AI, which is very, very intensive, so energy intensive. So a lot of demand is coming from there, and across the world, we are trying to shift away from fossil fuels to electric vehicles. Now that also will result in a huge amount of electricity demand. So selectively, one could look at opportunities in this space where valuations are reasonable and where return ratios are reasonable. The one caveat is that given that it's a regulated business, in many cases, the shareholder returns may not be that strong. So one has to be careful about how one goes about investing in this space.
Rajeev, similarly as to where is it that you find opportunities, are also, the whole debate of what to completely avoid in this market. I mean, the reason could be anything, whether the sector is not in favor, you don't think there's growth sector, or you think, the valuations have run up ahead of themselves. Any pockets like these?
I think one space we are circumspect on is the newer listings, which are more startup kind of names, where they were privately owned and they came for listings. And some of them are breaking even, some of them are in small losses. And the whole focus is on revenue growth and going into newer areas. Now, let us say there are 10 such listed businesses. Maybe 2 or 3 of them will do well, but most of the businesses could end up losing money for investors. I don't know which ones will succeed, which ones will fail. But today, you see digital advertising for this 10-minute grocery delivery. There are at least 5-6 players competing for that. And it's not something which is a very, very high margin business, given the relatively low ticket size and the need to have so many people feet on street and things like that. So I'm circumspect on the startup kind of businesses. The other space which is mind-boggling to me is the consumer names. Now, a lot of people keep saying India is the growth area and our GDP growth will be so strong and things like that. But some of the FMCG names and some of the retail names, one is seeing that there are growth challenges. In fact, in some of the FMCG names, growth is very, very similar to developed countries. And we have valuation multiples of 60, 70, and 80 times earnings, which really baffles me.
Rajiv, wanted to understand your outlook then in light of the fact that it's an election year as to what the view would be on capex related themes, infrastructure, real estate, and so on.
We are not big investors in this space as such. Lot of capital expenditure, if it gets incurred, one has to really wait out till the capacity utilization starts going up again, because immediately after the capital expenditure, typically the depreciation, interest cost, operating expenses go up immediately, and it takes a while before the revenue starts kicking in on account of increased capacity utilization. So as such, we are not very keen on large capital expenditure kind of businesses, but some of the capital goods companies could do reasonably well in that space.
Rajiv, over the last 20 years, I've seen that every time when you bought IT in the downturn, you emerged as a winner. Sometimes it was Y2K migration which hit them, then it was global economy in 2008, then it was this entire digital migration where smack becoming digital. You bought IT in downturns, you got rewarded. But this time I'm getting a narrative, at least when we speak to some of your peers and industry experts, that AI is genuinely different, which is that it is eating into the pure framework of IT companies, and the implementers are of the view that they need to implement a different leg of technology which can be supported without the help of the Indian IT services. Do you think one should be a contra buyer in IT, or IT this time is on a verge of getting seriously disrupted?
So Nikunj, I also interact with our own people who develop stuff for us, and it's a side hustle that I do. I write small amounts of trivial code and stuff like that. So sure, generative AI is taking away a lot of the work that people had to do earlier in terms of writing long code and finding bugs and remembering the syntax of various languages and stuff like that. But at the broad level, so this is going to impact the junior level hirings. So surely a lot of the work that junior engineers would do, some of that can be taken over by AI and stuff like that. However, broadly understanding what the project is, what the outcome is required, how to at least think through the flowchart or the pseudocode as it's called, and then prompting the AI to do it, then figuring out whether the answer is correct or not, and stitching together various modules, all that work will still be required. And what a lot of time people miss out on is that these large companies, OpenAI, Microsoft, Google, Amazon, they will put out the modules on the cloud and for anyone to use. But finally, when it comes to implementing these things in a corporate, you require people to actually do that. So earlier, this concern was around SaaS companies. So people said, oh, you can just pull out a credit card and sign up to Salesforce, and you can do a CRM. You won't require IT people to implement it. But as it turns out, implementation is a big business. It's not that everything happens automatically. Same way here, let us say you want to use generative AI to handle your call center operations or to reply to emails that are coming in. It's not that it will happen automatically. Someone will have to go out and figure out how to do it, test whether things are going well or not, and so on and so forth. I'm not very pessimistic.
Rajiv, great to have you on the show. Just wondering, how is it that you did not make it to Omaha?
So I saw Ronak is there. So he's
Okay.
representing
you. Okay, great. We'll chat again soon. Thank you so much for taking the time out and joining in.
Thanks.
If you like this video, then like, share and subscribe to ET Now.